they don't necessarily explain it, unfortunately.
Yeah.
So, going along that line though, if today's rate is X, everyone's got, that's the average. Now, the other thing you have to understand is when you're watching, like Freddie Mac will put out its national rate. So like California, all the way to New York and everybody in between. So the Midwest is, we might pay more, we might pay less, they pay more. So everyone's a little different. So when you're looking at averages, that's exactly what it is. It's an average. So, and again, when you're calling and shopping around, if you're under contract, you can shop. You can call and ask what your rate is. If you're just a pre-approval, your loan doesn't get locked in until you're under contract. So anyone could tell you anything they want that day to get your business. However, is that rate real? That's the question sometimes. Or did they not tell you about points or whatever it is? That's another thing you just have to be aware of, is the loan's not being locked. So when people call me and say they're shopping rates, I'm like, oh, are you under contract? Well, no, I didn't even start looking yet. Okay, so the rate doesn't matter right now
for you. Yeah.
To me, it's more about the payment. If you can afford your payment, does it really matter what the rate is at that moment in time? Of course, you're going to get the best rate possible, but that's not until you have a signed contract.
Right.
So just a little something to know.
And then what about refinancing? I know we talk about that because like my whole philosophy to clients when I get this conversation and I've questioned, I've had it over the past 2 or 3 years as rates skyrocket coming out of COVID.
Yeah.
But, I say date the rate, marry the house. That's just, a funny term that I like to use. You'll hear other people in the real estate industry say it as well. But, date the rate, marry the house, because I tell my clients, what you get in today, you're getting in and you're going to start building equity.
Correct.
So, and as long as you keep your financial profile healthy, right? That's credit, maintaining income, all of those things, nothing changes. You can refinance at some point.
Absolutely.
It happens all the time. So do you get that a lot? Or do you tell buyers that as they're talking to you about rates and they're kind of on cold feet because the rate is too high and,
Well, we always let them know, although this is a 30-year, because you're signing a note for 30 years, right? It doesn't mean you have to be, you can win the lottery tomorrow and pay the whole thing off, and there's no penalties to do that, right? So yes, you can refinance. However, and I agree with you. My thing is, like, I've been getting tons of calls from people who are like bought a couple of years ago and they're like in the higher rates right now. They're still the same. Maybe they're a little bit better, but it's not. It's got to. So in Illinois, we have something called a tangible benefit that we have to fill in. It has to be a benefit to the person to refinance. You can't just refinance just to refinance, because back in the day they had something called churning, where people would refinance like every month and they were skipping payments every single month, and it was either prolonging foreclosure or prolonging defaults or whatever along the way, and unfortunately you had loan officers that just kept making money, and you were stripping the equity from the house, because each time you did it, you're adding closing costs and everything, and now you lost all your equity because you kept refinancing. So they have a tangible benefit. And I just had someone ask me yesterday, what's the rule of thumb? There is no rule of thumb. It's just like some people say, oh, it has to be a point lower. No, if you have a $700,000 loan, you don't have to wait for a whole percentage rate. It could be a quarter, half a percent, and your payment is $400 in savings
or less.
It's
right?
based on your loan size. Like, I'll use my own example. I only owe $100,000 on mine. Anything I do at this point in time would not be worth it for me, because it would only save me like $40. I'm not willing to go through all that to save $40. So if you're someone so that's why a lot of times I tell people, stop thinking about the interest rate. And a lot of times they're so hung up on the interest rate. And then, a year from now or 2 years from now, I'll say, well, what's your interest rate? Well, I don't know. Well, remember how upset you were about it?
Right.
Now you don't even know what it is.
Right.
Do you know what your car interest rate is? Like, I just talked to someone who's being charged 23% on his, he didn't even know until I talked to him that he was mad. But why do you know that 4 years later?
Right.
So you've been making your payments. So to me, if you can afford, like you just said, if you can afford the payment, hang in there. What goes up must come down. It'll happen eventually.
Mm-hmm.
Do we know when? Absolutely not. Because
Yeah.
I follow the same data you do.
Yeah.
We all hear the same thing where we're scratching our heads. This happened, so it should have come down, but instead it went the opposite direction, and it's been doing that for almost 3 years
Yeah,
now.
and it's all about goals too. Because if it's in your heart's desire to buy a home or
Correct.
buy investment
Correct.
property, you're gonna do it now. Tomorrow's not promised.
Right.
So why am I going to wait for this rate that may not come down or may not
Right.
come where it's going to be a huge savings
Well, the
to me,
COVID
right?
rates, I call them COVID rates.
Absolutely. Yeah.
I'd be surprised if we ever saw rates in the
I don't
twos
think
again.
I don't think we'll ever see rates that low
However, I will
again.
say that a lot of people did lose out on buying homes
Mhm.
that were at a lesser price because
Right.
the prices continued to
gone
go
up.
up. So now you've got the higher rate and the
And the
higher, and
higher
I'm pretty sure we
value.
were telling people that, and they didn't. They thought we were just trying to sell them, and we weren't trying to sell them. We were trying to educate. At least you're buying the asset at a
Lower
good
price.
price.
Yeah.
Now it's higher. Like that comes up a
Mhm.
lot where people are regretful. So
Yeah.
then I'm like, okay, well, don't do it again. Now, if you feel like you can do
Yeah.
it now, if you can afford it and it's something you really want, like you said, then do it. And only you know if it's right for you to
Right.
buy a house.
Right.
Only it's your situation, your paychecks, your bills, your life. If that's something you want to do and you can afford it, then it's your time.
Yeah,
That's the
I
way I look
agree.
at it.
No, I agree. So we've got about 10 minutes left, but I want to kind of
Yeah.
talk a little bit about multi-units because
Yes.
here in Chicago, I feel like I know I'm personally seeing a shift. A lot of my clientele
Mhm.
are looking for multi-units, and sometimes the lending requirements for that can be a little different. So I want to touch on
Absolutely.
what they are. Right.
Yes. So, first of all, if you're trying to purchase using FHA in a multifamily, as I said earlier, it's primary residence only. You cannot purchase a multifamily, actually can't purchase anything without living in the property, FHA. But a lot of people that are using FHA for multifamily, you have to know that you have to occupy one of those units. Also, you can't have more than one FHA.
Mm-hmm.
Unless there's like rules about 100 miles away and job relocation, there's all this stuff. So and FHA literally says in their guidelines, this is to stop people from trying to accumulate, multiple buildings, and skirting around the fact that they're investment properties.
But you can have FHA and conventional.
Correct.
And
you sure can.
VA, right?
Yes.
Yeah. So I'm
yes.
like, yeah.
You can.
Yeah.
Occupancy does become an issue down the road. Obviously, if you just bought a property and said you're going to live in it, and 2 months later you're trying to buy another one and say you're living in it, from a lending perspective and underwriters, even if you're not going to the same lender, an underwriter is going to see that. I mean, it does come into play. If so, just something for people to be aware of. That's something that we're looking for. But so you can purchase conventional. Actually tried to be, or let me stick with FHA. So FHA has some strange rules, as you know, if you're trying to purchase a 3 to 4 unit, so up to 2 units, it's the same as a single family. But when you get to the 3 to 4 units, there's something called the self-sustainability test. So basically, the property the rent for all the units, including the unit you're going to live in, 75% of that has to cover the mortgage payment. So we never get to use the full rents either. We only get to use 75% of it. So it's called a self-sustainability test. So if the rents are low, so like some of the up and coming neighborhoods, right? The buildings are expensive, but the rents are still low,
Right.
because it hasn't caught up yet. I always joke around and say, you want to be a part of the up part, not the coming part, right? So you hope the rents are the up part and and the building is the coming part,
right?
But a lot of it is the other way around. So if you're still seeing lower rents, those buildings are not meeting the sustainability. And that has nothing to do with you as a buyer. It's the property itself doesn't qualify, and that would happen for anybody using it. You also have to have 3 months mortgage payments and reserves. So if your mortgage payment is $4,000, you have to have $12,000 in reserves after closing, and it cannot be gifted. It has to be your own funds. The good news is that could be money that's in your 401k. It doesn't have to be liquidated, but you do have to have the reserves. So I think this is the self-sustainability, and the reserves are a big reason a lot of people, they don't understand that. They don't talk about that on TikTok.
Right.
Anyway, so then conventional, last year in 2023 came up with a 2 to 4 unit. It's Fannie Mae only, by the way. So Fannie Mae 2 to 4 unit, 5% down, which is huge.
Oh, that's a big one.
This is primary residence. So it used to be 20 to 25% down even on a primary residence and 15% down on 2-unit. Now it's 5%, that was a
Yeah.
huge thing that Fannie Mae did to obviously help offset. I think this is the self-sustainability became an issue. And I think that they jumped in and saw there was a need for the multifamily. And that's what happened. Now, you still have to have reserves, but those could be a gift. I
Okay.
believe it's 6 months. I'm almost positive it's 6 months reserves. But again, that could be a gift. Conventional doesn't mind if you have a gift on that. But you're still looking at landlord. You have to do like landlord training, like things like that. There's certain things that have to be done in order to, and in all honesty, if you're buying your first building and you've never been a landlord before, I don't think it's a bad thing to learn, because there's a lot of things TikTok's not telling you about being a
Absolutely.
landlord.
Yeah.
So it's important. So but those I think are the biggest. Now you can always buy a multifamily as an investment property. You can use traditional, so conventional. Fannie and Freddie do allow for the owning it. You can also use commercial. So believe it or not, commercial lending will allow you on multi-units to
Right.
do it as well. I mean, it's a different animal. I'm not commercial, but it is something that if you don't fit into a traditional box, maybe you fit into the commercial box. It's just another
Yeah.
option, I feel like, to know. But those are really the biggest parts. And I will say that if you live in a single family house and you're buying a multifamily and you're saying you're living in it, you have to have a really good explanation for an underwriter how you're going from a single family house to an apartment, and all that, how what's the distance from your work, like all that stuff. So again, I think those are the things that people don't know. I'm a firm believer, if I have a unique situation with my buyers, like that kind of stuff, what are their intentions? Like maybe somebody's downsizing, or they're letting their kids stay in the house and they chose to move into the apartment, or it's people separated, or it's closer to work, whatever. I always have my buyers write a letter to the underwriter. Underwriter never talks to the buyers. It's paper in front of them, whereas I have the relationship. So I always have them write it coming from them, and it helps connect the two people that normally wouldn't have a conversation. Again, that's because I was an underwriter. I loved reading letters from the buyers.
That's great.
Yeah.
We love helping them write them. So for the underwriters,
hopefully
yeah.
does that answer? Did you?
Yeah, no,
Okay,
that does answer the question. I know I get a lot of questions too, and I'm sure you've heard this as well. People that own single family homes or even own a multi-unit now, and being able to do that home equity line of credit, or what's called the acronym is a HELOC, but to pull out money and then go buy something else. I feel like that's a strategy.
Absolutely.
I tell
as long as you
people
qualify.
that all the time, right? As long as you qualify, because most times that money will probably be your down payment money.
Absolutely.
But do you get that a lot as well?
We get people who try. I think the problem is people think they could go to 100% equity, and they don't understand that you can't.
Right. What is it, 80%? Or
it depends on the bank. Actually, I work with. I have a bank that actually will go to 89.9%.
Nice. Okay.
So it's
Close
almost
to
10.
90.
It's almost 10. Yeah, which is pretty great. Otherwise, a lot of them, it depends on the bank. Some of them are 75. They want 25% equity, 20% equity, 15%. It really just depends. But a lot of people get upset when they think they can get how much they want all the equity. And I'm like, well, then you have to sell the house and you get all the equity.
Right.
So
yeah.
it's your other option. Home equity loans, though, are expensive right now because they're tied to their rates are tied to rates just like everything else. So those are, and also
they fluctuate too, right? I've been getting calls about that from clients who have done it, and they're like, Jillian, why is my my rate is fluctuating? It was 800 last month, but now it's 1,000 or 1,100. So why is that?
It's so those are tied to the market, and those are considered variable. They're variable rates. They're the only way you can not have that is if you actually do. I'm gonna throw another acronym. It's called a HE loan.
Got it.
So instead of having the line of credit, you could do a loan. You take all the money at one lump sum, and they'll give you a fixed rate, and then that never changes. But if you keep it as a line of credit, it's like a credit card. Just like our credit card interest rates go up, the home equity loans the same way. And again, it's based on how much did you take, how much equity do you have left, what's your credit score? It's the same thing. And then also those are interest only typically. So you're only paying the interest. So if you have an $800 payment, that's all interest. So
So
your
you're not paying the
balance,
principal at all,
no.
right? Yeah.
And then some people don't know you have 10 years a lot of times to
Mhm.
pay it. So at the end of 10 years, it balloons. So if you
Right.
haven't touched any of your principal, you got to be ready for that.
Interesting.
Yep.
Yeah, that's
Most
interesting.
people refinance the second into the first. Almost everyone I know that takes out a home equity loan eventually does a refi to combine the two together. And I always have to laugh, not in a bad way, but I'm always like, I remember telling you about this. And they're like, yeah,
Right.
but they needed the money at the time. And so what, for whatever reason, whether it was down payment, consolidate credit, whatever, they felt that they needed. I just always try to talk them through, is this really what you want? Here's what will happen in the future. Right? Because like you said, we never know. However, there are things that can happen. And I'm always making sure people are aware. If you don't know that, you might not make the decision you make. So I always want to make sure they understand those things going
Got it.
forward.
And
Yep.
then my last question for investors, because
Yeah.
I work with a
Yeah.
lot of investors and I love working with investors, but I am most times throwing out hard money or private
Yeah.
money options to them
Mhm.
because they want to flip.
Yep.
So, but they don't necessarily have all the funds to buy the property and then renovate it. So, have you had experience or share your, I guess, opinions of private money, hard money, and then even 203K, because we didn't touch on
Oh,
that,
right.
how
Renovation. Mhm.
there is a renovation component as a part of the traditional lending of FHA or conventional. So
Yes.
kind of talk
Yeah.
to a little bit about that.
So the renovation loan, the FHA has to be primary residence again, but you could do renovation loans. It's basically financing all the costs. You cannot do the work yourself though. It has to be done. You need a general contractor with license, and then you have to be on the timeline of the lender and all that, which I think most people end up not liking because they like to do it themselves on their own time, but you're following all that. Conventional also has one. However, conventional also has one. One unit can be investment property renovation. I believe it's going to be like, I think 15% down. So it's not a huge down payment, but you still get to finance all the costs in there as well. I've personally never seen anyone use the investment renovation. I do have a couple sources for fix and flips and bridge and other private equity money that are willing to work with people on different levels, like, new people that are doing it a long time. So if you needed a resource for that, I do have that to be able to help. And I don't think I think you just need to know what you're getting into, I think is what it is. It's just like anything else. Read it, know it. You're signing your name. You're the one responsible. I think that's the only advice I could give people is, and of course, in those situations, those are riskier for different reasons. So of course you pay more for them. However, if you're someone who continues to do this, I believe that most of those lenders are relationship based, and then it kind of gets a little easier and maybe they're a little more relaxed with you. So,
okay.
Yep.
So as we prepare to wrap up, just kind of a couple final questions. So Tina, if you could give one golden piece of advice to home buyers or investors about the mortgage process, what would it be?
Participate. For real, participate when you're so for example, if you were working with someone else and they didn't ask you to turn in documentation, and then you work with me and I'm asking you for these things, it's not because I want to look at things and I want to spend time. I'm doing it for you because, again, I want to make sure that I know your whole picture. Underwriting knows your whole, like, we want to make sure that we're setting you up for success, not failure. So if you're not being asked up front for pay stubs, W-2s, if you're not being asked the right questions, you might want to get a second opinion, because everyone has to supply documents. I don't care who you are. It's just a matter of when. So participate. That's honestly my biggest. Don't fight it.
I love that.
Understand
No,
and ask questions while it's
yes.
happening.
Yeah.
Always ask. I will answer. To me, the unasked questions are the silly questions.
Well, the one thing about you that I've learned over the years is you are always supplying clients with more information than they, and I won't say
Probably.
don't need, but because it's you, and having conversations with you, even if I'm talking to you about a client, you will not only educate me, but you'll throw something in there that I don't even think that they thought
Right.
about.
Well,
right. So
right.
even for me to go back to them and say, hey, I talked to Tina, she mentioned this, and they're like, oh my God, we didn't even think about that, or that's an
Right.
option.
Right.
So, I appreciate that
try.
you do that. No, but and being a participant, them being a
Yes.
participant helps them
Huge.
get educated on
It
this,
does.
because a lot of people just go, you get a mortgage, but you don't know what you're getting or what you've
No.
signed. right? So
And we don't like to get those calls after my taxes went up, I can't afford my
yes.
house or what. Like, this is why you want to listen, participate, and pay attention when you're talking. Like, honestly, pay attention,
Mm-hmm.
because you're the one making the payments after closing, not you, not me.
Right.
They're making the
Right.
payments.
Yep.
Yeah.
So if how can listeners reach you if they've got questions or they want to begin the mortgage loan process or even do
Or
an
just ask
application
questions.
or just
Yeah.
ask questions? Absolutely.
I'm always happy to talk about
Yes.
it. So the best way always to get a hold of me is my cell phone, and my number is 312-391-2185. And I think that's gonna be the best way for right
Email.
now. Yeah, I could give you my email. My email, do I have to spell it? Probably. My email, TINA period ABBATECOLA @rate.com. So
Perfect.
yeah.
Perfect.
And then I can always talk. We have some really great programs. I have a great app. I'm actually new to the company.
Mm-hmm.
It hasn't even been officially announced on Facebook or Instagram yet.
I'm the first person where this is an announcement or release here on my show. I'm like feel so
Yay.
honored.
Meaning, like, yeah, it's but we have a really great app with all kinds of stuff. So if anyone really is interested, as you know, I'm not a pushy person.
Mm-hmm.
I'm not here to sell anyone. If you want to work with me, I'm
Yep.
happy to work with you. If for whatever reason you don't feel that we vibe and we're not good, then I wish you
She
luck.
will refer you to another lender. That's the one thing. That's when I knew I really liked you. I mean, when it's been clients that she knows I'm not going to be able to do something for,
Yeah.
but I have this other lender,
Yeah.
you know, that's over here that
Yeah.
their requirements are a little different.
Yep.
Tina will refer you out. So
Yeah.
it's not just about doing business with her.
Right.
It's about you getting your needs, your real estate needs met. So I
It's
just,
true.
I want to
Thank
say
you.
thank you for that because I don't know if I ever say that, but
Thank you.
we appreciate that about you. It just shows to speaks to who you are.
Well, it really is about the buyers for me. And if I don't have something, I'm not going to, like I said, stand in the way of them doing something. And I do make sure I have the right people around me that will take care of them and not throw them out there to the TikTokers out there. So
Yeah. Well, I appreciate that. So we that's actually a wrap for today's episode on the Inner Circle podcast. A huge thank you to my incredible guest Tina Abbatecola
you.
for breaking down the mortgage lending process and providing an invaluable tips for first-time home buyers, seasoned buyers, and investors. So your expertise and insights have
Thank
been
you.
like super empowering for our listeners, and then even for me, you still continue to educate
Thank
us
you.
as realtors. So I appreciate that. So to all my listeners and viewers out there, don't forget to tune in every Saturday at 11 a.m. for the next for another episode where real estate meets real life. I'm always your host, your homegirl Jillian, aka Jillian Owens. Stay intentional, stay focused, and keep building your dreams. Thank you for tuning in to the Inner Circle podcast. We'll see you next week.
Merry Christmas
and happy holidays.